APAC's asset and wealth management industry recently saw further evidence that APAC's next-gen investors are more likely to change their wealth managers. Singapore's private banks look to recruit their up-and-coming high-net-worth individual clients. Hong Kong passed legislation to establish a stablecoin regulatory regime and framework, and China start to aggressively tax overseas investments. Let's take a deeper look at these, as well as other headlines and developments. And now to China. The CEO of JP Morgan has vowed to deepen the firm's engagement with China, as reported by Chinese state media during a meeting in Shanghai, despite noting that there was increasing pressure on the financial institution amid geopolitical and trade tensions. The comments come amid the US Defense Department adding Chinese battery firm CATL to an investment blacklist, and the US House Select Committee on the Chinese Communist Party calling for Bank of America and JP Morgan to withdraw from working on the company's listing in Hong Kong, though both US banks stuck with their involvement. JP Morgan has a deep presence in China's capital markets. In addition to a securities business, it was the first foreign firm to own a futures company and became the first foreign player to take 100% control of its fund management company joint venture back in 2023. In 2023, Mr. Diamond was noted as saying that parts of the China business had fallen off a cliff as a new regulatory approach had seen local and international listings dry up. Whether such optimism is rewarded and whether JP Morgan can continue to navigate an increasingly fraught business environment will be watched with avid interest. Moving on. Chinese investors who have been trading US and foreign investments are receiving reminders to disclose their foreign-sourced income to local tax authorities, with some reportedly being asked to check back to 2021. The move comes as China appears to be more active in enforcing its global income tax rules. These have been enacted since the 1980s and were reaffirmed in a 2018 revision to the individual income tax law, though foreign income was not consistently assessed until recently. Recent actions by the tax authorities reportedly concentrate on interest, dividends, and capital gains from foreign securities. Tax authorities in Hubei, Shandong, Zhejiang, and Shanghai each issued statements in March 2025 stating that they had utilized big data to issue alerts regarding unreported offshore income, with one resident in Hubei reportedly paying 1.4 million RMB in late tax and penalties. Improved access to cross-border investment data appears to be a leading factor in the increased attention being showered on investors, with China participating in the Common Reporting Standard since 2017 and exchanging data since 2018. Next up, the decision by Chinese authorities to impose substantial reductions in the compensation for fund managers whose portfolios underperform their benchmarks could see the managers lower investment risk and look to more closely replicate the indexes that they are being judged against, according to industry observers. Should the portfolio managers find themselves slapped with lower returns and pay freezes, they may become demotivated and struggle to make their actively managed products stand apart. This follows CSRC, China's main securities regulator, announcing that portfolio managers who underperform their product benchmark by 10 percentage points or more over a 3-year period will see their performance-based compensation seriously reduced. Those who underperform their benchmarks over a 3-year period will be allowed to take reasonable and moderate performance-based pay increases, though the rate at which pay would be increased or decreased was not specified. A note from Chinese brokerage firm Guotai Haitong Securities stated that between 2022 to 2024, up to 64% of active equities-focused funds in China underperformed their benchmarks by over 10% over a 3-year period. The threat of substantial reductions in pay may see portfolio managers adopt a lie flat approach, a phrase akin to quiet quitting in the West, where the minimum effort to get by is applied and the notions of overworking and overachieving are rejected. Over in public fund updates, the number of low-cost funds, those charging annual management fees of 0.15% or less, in China now exceeds 1,000 for the first time, according to Wind, a Chinese financial information services provider. Sustained reforms and widespread reductions in fees due to regulatory requirements are the key drivers of this trend, with several of China's leading public FMCs at the forefront of the cuts. As of May 2025, 23 funds have lowered their fees to qualify as low-cost funds, and 123 newly launched funds have taken management fees of 0.15% as their base. eFund leads, with 112 low-cost funds, followed by China AMC at 60, Bosera AM with 49, China Universal at 47, and China Southern boasting 43. The downward trend follows the fee reform initiative introduced in 2023 by CSRC, which sought to lower the management fees of active equities funds from 1.5% to 1.2% and custodian fees from 0.25% to 0.2%. The program then extended to QDII products, and the next stage will reportedly focus on sales-related fees, with the aim of lowering fund distribution costs and saving investors 45 billion RMB annually. Further, on the back of a rally in Hong Kong's equity markets and an increased focus on the themes of technology and innovation, Chinese fund management companies are racing to launch Hong Kong equity funds, with players like Franklin Templeton Sealand, China AMC, Huatai Pinebridge, eFund, and China Southern submitting a combined 7 applications over the week of 19 May 2025 alone, and another 8 applications for Stock Connect funds approved by CSRC over the same week. Industry observers see the flood of applications as a reflection of the growing optimism regarding the performance of Hong Kong's equity market, with both the Hang Seng Index and Hang Seng Tech Index growing more than 18% in the year-to-date to May 2025. This performance is reflected in funds as well, with circa 90% of the 239 public funds classified as Hong Kong Stock Connect funds generating positive returns for the year, with 167 seeing returns of 10% or greater and 78 seeing gains of 20% or more. Investors and fund managers alike are no doubt hoping the good times will continue to roll. Also, JP Morgan Asset Management, the asset management arm of the US bank, has reopened subscriptions to a global fixed income fund available for sale in China via the MRF with Hong Kong, following the halt in Chinese subscriptions in May 2025 due to mainland Chinese subscriptions exceeding more than 60% of the fund's assets and were nearing the recently raised 80% limit. The timing of the reopening of the fund to subscriptions from mainland China is interesting, as it follows Moody's, the bond credit rating business of Moody's Corporation, downgrading the credit rating of the USA and its treasuries from AAA to AA1. US treasuries are reportedly among 4 of the top 5 holdings of the fund, so investor reaction will be interesting to see. Over in China fund manager updates, Manulife Fund Management, the China onshore asset management arm of the Canadian insurer, is the only foreign-owned firm within the first batch of applicants seeking to launch newly designed active equities funds which feature tiered fee structures to investors in China. 26 FMCs applied to CSRC for the new product. The funds follow an action plan released in May 2025, which called for the high-quality development of public funds. The new funds feature a fee model which lowers fees the more the product underperforms its benchmark, while allowing for a limited capped increase to fees when performance exceeds the benchmark. Holdings of under 365 days incur only a base fee, while those held longer will see their management fees adjusted. The objective of this is to boost investor protection and long-term alignment between fund managers and investors. For top FMCs, at least 60% of actively managed equities funds launched over the next year are expected to apply the model. Existing products are currently out of scope. Of the 26 applicants, 21 are leading domestic FMCs by actively managed equities AUM, 4 are mid-sized FMCs, and 1 is a foreign-owned fund management company. All the funds contained in the first batch are benchmarked against indices like the CSI 300, CSI A500, CSI 500, and CSI 800. Regulators will review the situation following a 1-year period and adjust the framework before a broader rollout. Reportedly, participating FMCs have assigned experienced portfolio managers with impressive long-term track records to the products. Also, the wealth management joint venture between BNP Paribas and ABC, a French bank and one of the big 6 state-backed Chinese banks respectively, plans to launch more specialized and higher fee products which would invest in both onshore and offshore assets as it seeks to reach profitability. Thematic ESG and more fixed income plus products were also planned. One of the hybrid onshore-offshore products to be managed by BNP Paribas Asset Management was planned to launch around June or July 2025. The shift to products with higher fees comes as foreign players in China's onshore asset and wealth management sectors face high operating costs and an uncertain pathway to profitability. Some industry observers see the foreign-owned public FMCs needing at least a decade before they break even. Wealth management units, seen as being more expensive to establish than their public fund management counterparts, are estimated to require 1 billion RMB in registered capital, with 300 million RMB allocated for initial employee and staff costs. The BNP Paribas ABC Wealth Management entity is now expected to reach break-even later than expected, than its initial 2026 estimate. The entity has grown its AUM from 7.6 billion RMB as of end June 2024 to over 40 billion RMB as of April 2025. This growth was attributed to building trust with the over 300,000 customers it now has and expanding the products offered and channels that they were distributed through. With China's wealth management sector currently focused on low-risk domestic fixed income products, whether a pivot to equity and multi-asset products with an offshore allocation gains traction among Chinese investors will be interesting to see. And finally, the Qatar Investment Authority, the wealth manager for the state of Qatar, has received approval from CSRC to take a 10% stake in China AMC, the first such stake held by a Middle Eastern investor, and follows the announcement of the stake back in April 2024. While the purchase price was not disclosed, filings by CITIC Securities, a Chinese full-service investment bank and China AMC's largest shareholder, showed that it would not be below $490 million for the 10% stake. China AMC had AUM of 2.1 trillion RMB, circa $250 billion, including assets under management held via its subsidiaries as of first quarter 2025 per its website. The move will see QIA become the FMC's third largest shareholder, behind CITIC Securities and Mackenzie Financial Corporation, a Canadian investment management company owned by IGM Financial. Since 2024, there has been significantly increased activity between China and the Middle East, with several FMCs in the hunt to help facilitate cross-border asset management of the Gulf region's sovereign wealth funds and wealthy individuals. Some industry observers note that the region could be challenging to access for Chinese FMCs, and establishing onshore operations and building partnerships across the region would be needed. Whether the continued cozying up between the Middle Kingdom and the Middle East continues remains to be seen. So that is this episode's section on China funds and fund managers. Check out the links in our profile for this episode's other sections, and do comment if there was something that you think should have been included which was missed. Many thanks for watching. Hope to see you next time.